Create a 9 minutes video for YouTube about delivery looted. India's logistics giant explained vertical bar Finaxiom. When we think of India's digital economy, our minds often go straight to e-commerce giants like Amazon, Flipkart, and Meesho. But behind every successful online order, behind every package that reaches your doorstep, there's an invisible engine powering the system. That engine is logistics. And among India's logistics players, Delhivery Limited stands tall as the largest and fastest-growing fully integrated logistics company. In this video, we'll break down Delhivery's business model, financials, operations, technology edge, and growth strategy. To understand how it has become the backbone of India's e-commerce and supply chain ecosystem. The Rise of Delhivery, India's logistics backbone. Founded in 2011, Delhivery started with a simple idea: building reliable logistics solutions for the emerging e-commerce market. Over the years, it has evolved into a tech-driven logistics conglomerate, offering end-to-end solutions across express parcels, heavy goods, trucking, warehousing, cross-border shipping, and even supply chain software. By FY24, Delhivery became the largest integrated logistics company in India by revenue, servicing over 220 countries and territories through partnerships and technology-driven solutions. This is not just another courier service. It's a logistics infrastructure and technology platform designed to handle scale, complexity, and speed. Business model: asset-light but data-heavy. One of Delhivery's defining strategies is its asset-light business model. Unlike traditional logistics players who own massive fleets and warehouses, Delhivery focuses on partnerships. Instead of buying thousands of trucks, Delhivery works with fleet owners, franchisees, and delivery partners. As of FY24, it owned only 753 trucks out of the tens of thousands needed for its operations. This outsourced model gives flexibility, scalability, and lower capital intensity. But here's the catch. If it's asset-light, how does Delhivery ensure control and reliability? The answer lies in technology and data intelligence. Business segments: diversified but parcel-centric. Delhivery's revenue streams come from multiple segments, but the express parcel business dominates. 1. Express parcel services. 58.7% of FY24 revenue. Delhivery is India's largest 3PL, third-party logistics express parcel player. In FY24 alone, it shipped 740 million parcels. Its parcel network covered 18,500 PIN codes, reaching almost every corner of India. This includes small e-commerce packages, heavy parcels, and return services. 2. Part truckload, PTL. 20% revenue. Launched in 2016, this segment caters to B2B express shipments. PTL is crucial because small businesses and manufacturers often don't need a full truck. They need shared, cost-efficient transport. 3. Truckload, TL. 7.2% revenue. Operates through its platform Orion. Think of it as a truck brokerage marketplace where shippers are matched with fleet owners in real time. Over 50% of its outsourced fleet mid-mile transport is now sourced through Orion. 4. Supply chain services, 11.9% revenue. Delhivery is not just about transport, it builds end-to-end supply chain solutions for corporates and e-commerce. Services include warehousing, fulfillment, order management, and returns handling. A massive differentiator is their data-driven supply chain optimization. 5. Cross-border services, 2% revenue. Launched in 2018 with door-to-door and port-to-port services. Expanded to air cargo services in 2019 via its global service Starfleet. Partnerships with major airlines allow coverage of trade corridors like US, Europe, and China. Infrastructure, gateways, and automation. The strength of a logistics company is in its hubs and gateways. As of March 2024, Delhivery operated 29 sortation centers, fully and semi-automated, 111 gateways across India. Automated capacity of 7.1 million shipments per day. Its Bhiwandi Mega Gateway, 1.2 million SQFT, is among the largest in India. Another hub in Hyderabad scaled from 40,000 to 140,000 bags per day, showing how Delhivery is betting on automation and scale. Automation is critical. It reduces errors, improves speed, and allows scalability. Technology and data intelligence. The secret weapon. What makes Delhivery different from a traditional transport company? The answer is its technology-first approach. Delhivery runs 80+ applications to control every aspect of its logistics, from order booking, routing, fleet allocation, fraud detection, to delivery tracking. Since inception, Delhivery has collected data for 1 billion+ orders and over 30 billion shipment lifecycle events. This data powers AI-driven decision-making like real-time route optimization, predicting delays, fraud detection, dynamic pricing, and bidding in its Orion truckload marketplace. In short, Delhivery is as much a tech company as it is a logistics company. Key metrics. Q1, FY25 snapshot PIN code. Reach, 18,783 gateways, 112 delivery points, 3,567 employees, 67,897 active customers, 35,277. These numbers highlight Delhivery's scale and network density, unmatched in India's logistics industry. Financial and cost management. Logistics is a tough business. Low margins, high costs, and competitive pricing. Here's how Delhivery manages it. Freight and handling costs rose by 5.3%, due to higher volumes and network expansion. Employee costs rose by 2.6%, reflecting wage hikes and headcount growth. But efficiency gains from automation and Orion sourcing are helping Delhivery offset rising costs. Strategic investments and expansion. In FY24, Delhivery invested heavily in infrastructure, automation, and technology. Rs 601 crore capitalized in IT systems and automation tools. Rs 28. 5 crore in ongoing capital projects. Expansion of gateways in Bhiwandi and Hyderabad. Added 150 tractor-trailers, 46-foot, for long-haul transport. The focus is clear. Build capacity ahead of demand. Challenges and risks. Despite its leadership, Delhivery faces challenges. Thin margins. Logistics is a scale game, and profitability depends on constant efficiency. Competition. Rivals like Blue Dart, DTDC, Ecom Express, and Amazon's in-house logistics. High dependency on e-commerce. A slowdown in e-commerce growth directly impacts volumes. Fuel and freight costs. Rising fuel prices can impact profitability. Conclusion. Why Delhivery matters. Delhivery isn't just another logistics company. It is the circulatory system of India's digital economy. Every online order, every small business shipment, every B2B load that moves across states, Delhivery plays a role in it. Its asset-light model, tech-driven intelligence, and focus on automation make it a unique player in a highly competitive industry. As India's e-commerce, retail, and manufacturing sectors expand, Delhivery is well-positioned to capture the opportunity. But the real question is, can it balance growth with profitability in the long run? For investors, analysts, and customers alike, Delhivery remains a company to watch closely as it continues to redefine logistics in India. Expanded financials and key metrics. Top-line growth and revenue trends. Delhivery's 5-year revenue CAGR stands around 26.3%. In FY25, the company reported revenue from services Rs 8, 932 crore, up 10% YoY from Rs 8, 142 crore in FY24. On the consolidated basis, including other income, total revenue was Rs 8, 709 crore in FY25. Thus, while profit growth, SAGR 19.7%, has been strong, Delhivery's revenue growth has also been healthy over the medium term. Profitability and margins. FY25 was Delhivery's first full year of net profit, earning Rs 162 crore versus a loss in FY24. In Q1 FY26, the company posted profit after tax Rs 91 crore, which is a 67% YoY jump from Rs 54 crore in Q1 FY25. Q1 FY26, net profit margin improved to 3.76%, versus 2.4% in Q1 last year. EBITDA margin in Q1 rose to 6.5%, up from 4.5% a year ago. Margins over the latest trailing 12 months. Gross margin, 84, 2.58%. Operating margin, tilde 1.50%, negative. Net margin, tilde 2.20%. So, while gross margins remain very strong because the cost of goods sold is low compared to revenue, operating expenses are high. Only recently, with scale and cost discipline, has the company forayed into consistent net profitability. Balance sheet and capital structure. As of FY25, total assets, tilde Rs 12,063 crore. Total liabilities, tilde Rs 2, 631 crore. Equity, tilde Rs 9, 432 crore. Debt is modest relative to equity. The debt-equity ratio is tilde 0.15. That is 15.07% in the trailing 12 months. The company also has a net cash position. It has tilde Rs 2, 892 crore in cash versus tilde Rs 1, 422 crore in debt, giving net cash of tilde Rs 1, 470 crore. Liquidity also looks healthy. Its current ratio is tilde 4.23x. This relatively clean balance sheet gives Delhivery breathing room to invest in growth, absorb shocks, and expand operations without over-leveraging. Return ratios and efficiency metrics. ROE, return on equity, tilde 1.52% for FY25. ROAS, return on capital employed, tilde 2.47%. Tracking metrics from stock databases also suggest low return metrics historically, though improving as profitability becomes more stable. One interesting working capital insight. Over time, Delhivery's working capital days have improved from approximately 118 days earlier down to approximately 67, 5 days. This shows that the company is getting more efficient in managing receivables, payables, and inventory cycles. Interpretation and takeaways for your script. Profit growth has had to catch up to revenue growth. While delivery has grown top line rapidly, tilde 26% CAGR over 5 years, profitability trailed due to scale, high fixed costs, and operating leverage. FY25 marked a major milestone. Earning a full-year PAT in FY25 is a psychological and structural turning point, indicating that the business model is shifting from growth at all costs to sustainable growth plus returns. Margins are improving but still constrained. The jump in Q1 FY26 margins, net margin 3.76%, EBITDA 6.5%, is encouraging, but to become a durable high-margin logistics player, Delhivery will need to maintain control over operating costs while scaling volumes. Strong balance sheet gives room for maneuver. Low debt and net cash position reduce financial risk and help fund expansion without undue pressure. Return metrics are low. Room to improve. ROE and ROAS are modest now, but with scale and steady profitability, those metrics can improve significantly over time.